Hi everyone, today let's talk about Citigroup saying that small caps are set to sparkle. Then we'll look at the tentative deal between the UAW and Stellantis. Then we'll get into the usual data and calendars. Then we'll get into the charts. Then we'll look at my results for the week and my thoughts going into next week. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this every single day that the markets are open as well as Sundays, so make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So looking at small caps, we've been talking about how small caps are oversold relative to the major indices, but they have continued to underperform up until basically the end of this week, and we'll take a look at the ratios, but let's take a look at their argument. They say high quality small caps and mid caps are currently trading at a 30% discount to the S&Ps, which I definitely agree with. I'm not sure that all of the IWM falls into that same category, but they are definitely trading at a discount relative to the major indices. But what is the allure here? There's definitely a little bit more risk. Sometimes they're less liquid. It kind of depends. Looking at the S&Ps versus a 50-50 S&P 400 versus 600, the 50-50 split has outperformed over the last 30 years. And it seems like there's more opportunity today than there has been recently. Also, taking a look at the ratios, just like I talk about every single week, you can see forward PE, S&P 600 versus the 500. We are back into that same range from basically the start of this previous chart where the 400-600 split did outperform for the next 30 years. And this is another potential to get into that same position for the next 30-year run. And they do even put the Russell on here. It did do okay, but it didn't outperform the 600 or the 400. Those were the best options. But as long as you look at the quality indices here, still going to be a pretty good return. It is worth mentioning here that they are saying this is not a trading strategy. This is an investing strategy, and it might be worth looking into an active manager on your behalf, or at least finding a passive way to invest in these quality indices. Moving over to the UAW tentative deal with Stellantis, they are expanding their strikes with General Motors, however. I do believe they have a tentative deal with Ford Motor as well. Yeah, they mentioned that here. So 4.5-year agreement between Ford Motor and the union. Apparently the Stellantis deal is fairly similar. Now we just have GM that is currently the standout as the one that has not really met a deal yet. The UAE came out and said they are disappointed by GM and their refusal to come to a fair agreement. In terms of stocks, GM has been doing the best, and they are the most competitive in terms of getting investors into the company. Ford has not really appreciated that much recently, and my guess is Stellantis is fairly similar. They said they believe they have achieved the impossible, and that they've secured a record contract on behalf of working Americans. The question is, what does this look like? We don't know yet. And I'm sure once the details come out from these proposed deals that we'll see these companies probably move to the downside just because of how much more money they're going to have to pay out in labor over the next several years. If they're anything close to what they requested early on in the negotiations, that is going to be a big hit to these companies, in my opinion. I don't really think they're going to be that close to those initial requests. They were pretty outrageous. But even if it's half of what they requested, that would be a pretty big bump to labor costs. In terms of Ford, they talk about a 25% pay increase over that 4.5 years, which isn't terrible. They were initially requesting that 40-ish range, which would have been a massive bump, but that's pretty reasonable. 25% over 4 years, a little bit over 5% per year. Not terrible. Does get them up to a pretty high wage, but it does seem fairly reasonable with the increase in profits these companies have seen. They mention here it's probably going to increase the cost of vehicles, $850 to $900, which isn't awful, but I'm sure it's going to cut into their profits, and we'll probably see the stocks move lower a little bit, in my opinion. Either way, it's good to see this coming to an end for both parties. Moving over to sentiment, you can see the bears are winning. Bulls all the way below 30%, well below historical averages. Bulls up at 43%. That is quite high, well above the historical average. Not quite to that 1-year high, but this is definitely saying we are in capitulation at this point. The question is, when are we going to get that reversal? We will get a reversal at some point, but the bulls are definitely winning, and sentiment is saying it's probably going to be pretty soon, in my opinion. Moving over to fear and greed, as you would expect, we are in extreme fear. Again, typically we're coming towards the end once we get into extreme fear. Doesn't mean that we can't go lower, but it is getting towards that bottom, in my opinion. See the initial breakdown, first wave, second wave, retest, bigger breakdown. And we'll look at that more on the charts. Relative strength has fallen off a cliff. right back to those October of 22 lows, actually a little bit below those lows, and that ended up being a very solid bottom for quite a while. Breadth, same region. We'll continue to look at those charts. Put call ratio has rolled over a little bit, which is interesting, especially with how low the markets finished on Friday. Volatility continues to rally, still looking for that 24.50 to 25 range, similar to the range back from mid-March of this year. Safe haven demand, people continue to buy into these short-dated bonds as they are continuing to offer very good returns. And then junk bonds continue to be in extreme greed, and they've held up quite well. Moving over to the economic calendar, basically nothing on Monday. Tuesday, we got CPI for the Eurozone, GDP for the Eurozone, consumer confidence for the US at 10 o'clock. That'll be the big one. Tuesday, JOLTS report, ADP non-farms, ISM manufacturing PMI, tons of data on the first. And then, of course, the big one, FOMC statement and interest rate decision. Just about everyone is expecting a pause at this point, very high percentage chance of a pause. But the question is, how hawkish will he be in this press conference? The assumption for me is still that they will be quite hawkish and they need to maintain that tone, but that they will pause at this meeting. And then looking at Thursday, we have factory orders, Fed balance sheet, and of course initial jobless claims. And then Friday we have unemployment data, non-farm payrolls, participation rate, private non-farms, US unemployment rate, global services PMI, tons of big data, non-manufacturing PMI, and non-manufacturing prices. So tons and tons of data this week. Taking a look at earnings, for Monday we got McDonald's, pretty much the only one, Welltower, fairly interesting. Tuesday, Pfizer, AMD is always interesting, Caterpillar, Marathon Petroleum. Moving over to Wednesday, we got Qualcomm. That will definitely be interesting. PayPal, always fun to watch. We have quite a few food brands on that same day with Yum Brands, Kraft Heinz. Could give you an idea of what consumers are still doing out there in the economy. And then the big one for the week, Thursday, we have the biggest player in the world. We have Apple after hours. And there's a lot of hesitation here with Apple. Their demand for the new iPhones seems to be not as high as expected, and that could pull the stock down, which typically pulls the whole market down. In that same morning, we do have Duke Energy. Energy has been interesting here recently. You also have Starbucks in the morning. And then Friday, basically nothing here. Dominion Energy, fairly interesting. Church & Dwight for you dividend investors out there. And that'll wrap up the week for earnings. Moving over to Max Payne, not very many options. This is an off week, just under $1 million. Put wallet for 10, which is basically right where we are for the end of the week. Doesn't mean we can't throw some wicks down into this range around 400, certainly possible. Bottom of the calls is currently 409. So we're basically already at the bottom of the range for the week. But look at that put call ratio, same as last week. Tons of puts in the markets, very few calls, potentially signaling some opportunity to the upside. Obviously, the charts are still very bearish. So let's get into the charts. Starting off with the S&Ps on the weekly chart, you can see 2 solid weeks in a row, about 2.5% each to the downside. At this point, you would expect at least a wick low, especially with how low this previous candle closed, basically right on the low. We can see a similar move where we had a big move down, gap down through a wick to the downside before seeing a rally, and that is what I'm expecting. Back down to this same trend line, marking that same low in March, the low here in January, kind of a pivot point here in October, and then the clear low in June of 22. And that level is currently sitting around 40.50. So that'd be about another 50 to 60 points of down move on the SPX, or that 405 area on the SPY. Test that level, and then we'll look for some support. Of course, you still have the 200 SMA sitting all the way down at 39.40 at this highly traded zone as well. You can see this previous consolidation. Right now, we're at the low from the April consolidation. It doesn't mean that we can't find some support there, but I would expect this to go a little bit lower ultimately. Moving over to the daily chart, you can see that highly traded zone right at that April consolidation. Couldn't make new lows during that consolidation, and then we rallied higher from there. And we are right there on my level, just by a few cents, 410.54, just barely above it. Next one for me, like I talked about in that 405.29 area, right at that medium-term trend line. Momentum still bearish. RSI just barely got into oversold conditions on the Friday session at 29.11. And just like this previous consolidation, I would expect to dip into that 405 area before we see any kind of basing or movement higher. and no change to structure. Everything very bearish. Took out a support level here on that Thursday, Friday session. We tested that support in August, tested it again here at the beginning of October, and now we've broken through it. And like I said, everything looks very bearish. Moving over to the NASDAQ on the weekly chart. Again, 2 big bear weeks in a row. Nearly 3% and then a little bit over 2.5% coming off of that 21 EMA. You can see we were riding that for a few weeks in a row and then we broke down from that level. And you would expect to continue here in my opinion. Longer term trend support still sitting at 13,861, which is about 300 more points to the downside, which is a pretty substantial move. You also have the 144 EMA sitting just behind that at 13,691. Bearish momentum, bearish RSI. Everything still looks very weak here in terms of technicals. We did touch this trend line, and we'll look at that on the daily chart as well, but we touched it and held a little bit more bullish in terms of structure than the SPY, but obviously not by much. Moving over to the daily chart, similar structure to the SPY. You can see that same downtrend line. We did take that out, but the downtrend line that I was talking about was this one here from the lows in July. Kind of chopped through that zone, but it did come into contact here in the end of September, and then once again touching that same level. That would be your expanding wedge type setup. To the downside, still very bearish. We did get an inside candle, which is typically a reversal type setup, which could be interesting. My only hesitation there would be the 200 SMA sitting at 339.29. We're already very close to that level, and I would expect to come down and get a test of that, even if we are going to bounce off the 200, which does seem possible at this point. We're just so close, and typically you get at least one touch before you see any kind of reversal of conditions. And right now everything is still bearish. Momentum bearish, RSI still bearish. Moving over to the Russell. At this point, this is basically done. So we closed on a new low for the week, below these previous lows from June and October of 22, well below the pre-COVID highs, well below this consolidation before the gap up. And we are below my trend line here, so everything says very bearish. I went ahead and added some levels here at 158.94, right at the top here from February of 2019, and the wick highs here in September of 19, and the same wick high again in August of 20. So watching that level right in that 158.94, 159 area. And then next one for me would be the bottom of this kind of shallow consolidation at 151.61, and right now this just looks awful. Everything looks like it's going to continue to sell off. Big bearish momentum, RSI not oversold yet, looks very weak. And now that all of this structure has broken down, you would expect to move back into this previous consolidation, and then even a move potentially down into the 145 area, which would be the bottom of this consolidation. In fact, I'll go ahead and add a level right there at that 145.50 area, which held markets from October of 18 all the way through October of 19, with just a little bit of a dip low before we got into that same area. Once we started to break out, then we had COVID and a big move down. So interesting structure, everything looks weak. Moving over to the daily chart, not much of a change. Everything still super bearish, closing below everything here. Like we talked about, 158.94 or 159 area. But you can see that new close on the daily low, well below these previous lows. Everything is technically broken, and it looks weak. Moving over to the Dow, similar to everything else, 2 big bearish weeks in a row. Still got the 200 week moving average sitting at 318.24, right in that same zone. Actually quite a bit of confluence at that level. You can see this dip low here from March, the gap down, gap up on the weekly chart, which ended up being a pretty nice little run. And I would expect to get into that level around 317, right in that 200 SMA. Then you have this more unusual trend line that I'm kind of watching. Just as a confluence in that same region, you would expect it to get into that area and then potentially find some strength from there, but I wouldn't expect it before then. Moving over to the daily chart, just so you can see a little bit better perspective of that downtrend line. Sure enough, we're at it one more time. We'll see if it holds. Based on everything else we're seeing, you would not expect it to hold, or it could grind on that level for a little bit to the downside. Momentum bearish. RSI did get into oversold conditions, and again, you have that confluence at that 318 area. Looking at the equal weighted S&Ps on the weekly chart, again, 2 big weeks in a row, 2.3% and then 2.45%, massive down weeks. Took out that 134 level, which was basically this pivot point here from October of 22. Next level for me, down at the lows from June of 22 at 131. And at the rate that things are currently going, let's go ahead and add a level at 127.26, right at this pivot low here from September of 22. You can see now we gapped through that 200 SMA on the weekly chart. Everything looks super bearish. We're below all the EMAs and SMAs. They're not quite in line yet, but with how it's going, you would expect it to. We very clearly took out this level from March and the highs here from June of 22, and everything looks super weak. Big volume on that down move. And looking at the daily chart, you have a similar structure where we took out that initial downtrend line. We're testing that steeper downtrend line now. You saw a lot of volume on the Thursday. I was curious if that was going to be a pivot point, but it turns out we had another leg down. And the question is, what happens now? Are we going to push right through that to that 131 area? Or will this potentially hold? We could get maybe a slight bounce up to 137.50 and then set up a lower high and get the continuation lower back into that 131 area. Could be interesting. Overall, everything is super bearish and a little bit extended, but if this trend line holds, we could see maybe a couple of days of bullishness before we get another continuation lower. Moving over to the ratios, copper divided by gold. We did have a slight pullback, so we took out this level at 1830, broke down, now we rallied back up to that level. I would expect this to be a retest and a continuation lower. Next level for me down around 17, and as long as this continues to look bearish, I would expect markets to be more bearish. But if we see a little bit of a breakout and maybe a rally back up to this previous consolidation, maybe we see markets go a little bit higher off of the trend line that we talked about. Moving over to the SPY Russell and NASDAQ SPY. We got a doji on the week for SPY Russell. Russell did outperform a little bit at the end of the week. The question is, will this be a pivot point at 2.52? I added a level here for this chart. It does make sense going back to the .com era as well. Pretty interesting area. Certainly possible as a pivot point. Momentum starting to fade at that level. Next one for me would be 259. But if we pulled back to 242, maybe we see some Russell outperformance. Moving over to NASDAQ SPY, we've been consolidating in the same region for a while. We did throw a wick down to that 343 area. Tested support. We'll see if it holds. Momentum bearish. RSI looks like it's pulling back. So you might see this ratio fall a little bit, see a little bit of outperformance from the SPY. And if the Russell is outperforming the SPY as well, then the Russell would be on top, SPY in the middle, and NASDAQ as the weakest. But right now we are still above support, and right now this is still a bullish structure on the SPY Russell. Moving over to the SPX divided by the M2 money supply, you can see we're right here just below 1992, right at that 55 EMA, but I'm zoomed out here because I want to highlight the fact that we are below that 2050 level, which seems to be kind of a peak rate. We did get above it for a pretty extended amount of time here during the .com bubble. You can see we got way up here, all the way up into the 30s. We've never got anywhere near that since then. But then you can see 2007 before that big crash, and then COVID right in the same zone. Most recent high, same zone, back into the 17s. And now we're back below 20. That seems to be just about where we can peak out. We did get the same high here as the all-time high and the pre-COVID high, but we're now into a range where it's more normalized. You can see we were in this range from December of 2017 all the way through until February of 20, with a couple of dips and rips here and there, but basically we've been in this range for a long time. If we do pull back into this 17 area, that would be a pretty good opportunity in my opinion. Momentum is bearish, RSI is still bearish, but just to put things into perspective, we are definitely more normalized, definitely out of that peak range. The question is what happens now. Obviously still looks very bearish, but in an area where we potentially could find some support either at this August high or the same high from January of this year. Moving over to Apple and Tesla. Apple has been in this falling wedge type structure. Tested that level once again here this week. Did find a little bit of support at 165.71. Got the 50-week moving average sitting just below at 163.72. Honestly, I would expect probably one more wick to that level before we found support. We're below the 9 and the 21 EMAs as well as VWAP, and they are in order. So this is a consolidation pattern. We're stuck between EMAs. We don't have a true trend. Short term, slightly downtrending, but longer term still in that uptrend. Bearish momentum, bearish RSI, which tells me I think we're going to get at least a test of that 55. Tesla, a little bit less clear here. We're below the shorter term EMAs, but we are right on top of that 55 in the 200 SMA. And we tested this intermediate downtrend line. If that level holds around that 204.62 area, then we could see a little bit of a rally up, kind of like we saw here. Test that level, rally up for a couple of weeks. But if this level breaks, then we're looking at this deeper downtrend line all the way down into that 185 area, which would be this previous consolidation, which also seems to make sense. Could go either way at this point. Right now, I would say down just because everything looks so bearish. Momentum, RSI, everything looks weak. It's probably just an initial pause at that level, and then you would expect a continuation, in my opinion. Moving over to Amazon and Microsoft, some of the biggest stocks that seem to be doing okay. Both of these had strong earnings. And you can see Amazon wicked all the way down to 118, ended up closing up at 127.74, touched that highly traded zone. But this is a big wick low, clear support coming in for Amazon. If this continues here, you would expect to move up to that 200, up around 137. Should be a nice little continuation, which could prop up markets a little bit and potentially protect us from the bigger down moves like we're seeing in Google. Otherwise, looking at Microsoft, you can see we're kind of in this flag setup, and it still looks okay. You could argue that this is basically a double bottom on a closing basis. We did wick a slightly deeper low on this second dip, but then we rallied up, had good earnings, threw wick up to 344.86. Still want to see it hold above that downtrend line and then potentially break out from here. But again, if this is a flag setup, this would be a massive move higher. We had a big run into it, giving you a really strong price target out of this zone. And momentum seems to be moving in that direction. Big volume on earnings. Everything looks pretty good here on Microsoft. Moving over to staples and discretionary. Staples did have a bearish week, down about 1%, better than the overall indices though. You can see volume ticking up in this consolidation. Does seem like we're finding a little bit of a base. We had that initial rally out, retesting that same level at 66.27. If that holds, then we could look for a bigger move higher, similar to this move here from that same level. We are below all the EMAs and SMAs, so you do have to factor in that this is a true downtrend at this point. But it does seem like some buying is coming in this region. Discretionaries, on the other hand, this just looks like a pure sell-off, continues to move lower. We got another bearish week, over 1% down, especially after throwing a wick to the upside at 153.90, rejected from that level. Below the 55 EMA here on the weekly. Bearish momentum, bearish RSI. Everything looks weak here. Next level for me, 147. Next one below that, 143 at the bottom of this consolidation low before we got this bigger break higher. Moving over to gold and transports. Gold continues this massive rally, nearly 5.5%. Over 2.5%, and then up another 1.3%. Massive moves, bullish momentum, got above all of my trend lines here now. Looks super strong. You would expect a retest of this previous high at least. On a closing basis, if we got to the bodies of the candles, that would be up around 187.77. And then if we got into the wick highs, that would be up around 190, 191. Certainly possible. Transports, on the other hand, had one of its strongest bearish weeks in a long time. Once this trend line broke, the dam broke massively, down 6.3% on that move. We did have moves kind of similar to this going back to September of 22, which did carry us into that October low, which ended up leading to a much bigger move. But after that big candle, we had two more bearish candles. It does seem like we're going to be pushing into that same zone. Took out 213, looking at 207.38 as a potential bottom. That was the pivot low here from June of 22. And then below that, 196.20. Everything looks super bearish. We're getting very close to oversold conditions, but we did accelerate here. And that is a lot of bearish weeks in a row with just that one green candle from the end of August. Moving over to breadth, looking at the 50-day average, bearish candle, not by much, kind of in the same region. We did have a wick lower from the beginning of October, in this same zone. If we do touch that 2.75 area, I would expect that to be just about the bottom, waiting for a touch of that zone before we can turn quite bullish over the next while. Looking at the 200-day average, however, we are still very much a downtrend. Almost looks similar to the transportation ETF, many weeks in a row with just a couple of bullish candles. Big breakdown. We did get to that 24.25 level. That was the one we had been watching. If this level holds, could be a nice pivot point. It has been in the past. As you can see, we had a couple of bounces through here. Once we get above it, that typically means we're going to see a bigger move higher, just like the break here we saw in July of 22, and then the bigger break here in October of 22. Big rallies off of that level. But now we're breaking back through that. If we do break further down, you could be looking at 1588, which was the lows here from July of 22. And then if that level breaks, then we're watching all the way down into that 11 area from the lows in June and September, October of 22. Moving over to the 2-year and the 10-year yield. 2-year actually selling off here quite a bit. Interesting. You like to see it. 10-year basically unchanged on the day on that Friday candle, but does look slightly bearish. If we see a little bit of follow through to the 21, maybe a bigger breakdown, that would be nice. But that 2-year is pretty encouraging. Bearish momentum, bearish RSI. And looking at these on the weekly chart, you can see it does kind of look like a rollover. We've been in the same zone, throwing wicks to that same level. Now we're breaking down a little bit more. 10-year yield still looks very bullish, almost parabolic. Wouldn't expect that to slow down quite yet. And it does seem like we're finally getting a reversion of the yield curve, which typically means we're going to see that recession type environment finally come through next year. Moving over to the dollar, basically unchanged on the week. You can see we continue to chop in this same zone, kind of similar to what we saw last time. Big move through, came back, tested this same consolidation. We ended up breaking higher to this September-October high, which was the low for equities. If we see another move like that, that could be quite interesting. We did get all the way to one candle of bearish momentum before we saw that bigger break higher. And that does seem like a possibility here. We continue to chop in the same zone, momentum rolling over. If this 105.50 level continues to hold with momentum kind of completing that cycle and then getting the rally out, that would be quite bearish for equities, but we're not seeing it quite yet. And if this acts as true resistance and we see a bigger breakdown, that could be quite bullish. Next level to the downside would be 104.40. Moving over to the VIX, we got a slightly bearish candle after touching that 200 SMA at 22.92. I still think we're going to hit that downtrend line up around 24.50. Does seem possible. Momentum bullish, RSI still bullish, and we're above all the EMAs, just that one SMA. Overall, this is still building, and I think we're going to see a bigger culmination at that point, similar to what we saw here. Going back to March of this year, we saw a big wick high, another wick high, and then we kind of gapped into this area and fell for a couple of weeks. Kind of need that culmination at the trend. And I do think that's what we're going to see. Moving over to my accounts, I was down just under $1,000, so not terrible. About 1% down move. NASDAQ was down about 2.6 on the week, so a little bit less than half. You like to see it. Not great. You still want to be up money, but not terrible either, I suppose. In terms of positions, I do have a short IWM position here. Just looking for 62 cents credit on that move. Everything is super weak. It looks like it's going to continue lower in my opinion. Qs, on the other hand, I still have a put at 347 for the third. Got some profit on that position. I do have some calls for the Monday session at 349. Again, I do have most of the profit in that position already. We'll see how that one plays out. Might roll it out at the end of day tomorrow. Obviously, it depends on price action. Shouldn't be too crazy on Monday, though. And then I do have a 352 call for $3.30. That goes all the way out to the third as well. So those are offsetting with puts and calls on the expiration for the third. Overall, bearish IWM with the bigger breakdowns, and realistically the NASDAQ is probably going to go a little bit lower as well. Let me know down in the comments section what you think about small caps. Are they going to be finding a more solid bottom over the next few weeks? Something that could lead to a longer term rally. Obviously be patient in the short term. That was a very long term based thesis. And then let me know what you think of the UAW strikes and some of the deals that they've reached so far. Is it as good as you thought it would be, or did they exceed your expectations? Definitely like and subscribe if you get any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.